Let's jump right in. $725 billion. Now, I know when we hear numbers that big, our brains kind of just gloss over them, right? We just scroll right past. But stick with me here. Half the internet right now is absolutely screaming that AI is the biggest bubble in human history, while the other half is swearing it's the biggest breakthrough since sliced bread. The crazy thing? They're both arguing about the exact wrong thing. They're totally distracted by all the noise on the demand side. To get to the actual, real story of this AI boom, we have to look at this incomprehensible, massive number. We have to look at the supply side. Welcome to The Explainer. Today, we're skipping past all those loud, narrative-driven arguments you're seeing in the media. Instead, we're going to dig into the quiet, purely mechanical truths driving the AI market. We'll be looking at a hidden framework that the world's absolute best investors have been using to track financial bubbles for, well, over 200 years. So buckle up, because what's hiding right in plain sight might just completely flip how you look at the future of artificial intelligence. Section 1. The $725 billion supply shock. Let's get into it. All right, to kick things off, we really have to wrap our heads around the sheer unprecedented scale of the AI build-out that's happening right under our noses. And it comes down to a fundamental difference between demand and supply. Listen, everyone is out there arguing about user growth, adoption rates, revenue projections. But here's the secret. Demand can absolutely lie to you. It's noisy, it's super easy to manipulate with a good narrative. Supply, though, supply tells the truth. You literally cannot fake the actual capital it takes to build data centers, to buy millions of chips, to lay down all that infrastructure. Supply demands real, hard capital committed up front. And honestly, this comparison brilliantly illustrates the pure scale of the bubble we're swimming in right now. Remember that $725 billion? That is big tech's projected AI spend for this year alone, just this year. To put that insane number into perspective, imagine if you spent $1 million every single day, starting from the exact day Jesus was born, going straight through the fall of the Roman Empire, both world wars, right up to today. Even doing that, you still would not have spent as much money as big tech is dropping on AI in just this one single year. It's wild. Let's break that down just a little bit more so you can feel the real-time speed of this capital deployment. That yearly figure, it roughly translates to $2 billion a day. Or, if you prefer, $83 million an hour. That is about $23,000 being spent every single second. Literally just in the few seconds I've been talking to you, big tech has dumped millions more into AI. We have absolutely never seen a bubble of this magnitude. Ever. Moving on to Section 2, the capital cycle theory. Let's look at how we track these bubbles. So, how on earth do we make sense of this massive flood of cash? Well, the best framework for this is actually rooted in some of the oldest economic ideas out there. We're talking Adam Smith, way back in the 1700s. He noted this really simple truth. When money naturally flows into industries that look like they have high returns, more competition enters. Obviously, right? But what happens when everyone rushes in at once? That intense mutual competition naturally drives returns down for everyone in the space. It's basically an economic law of gravity. What goes up must come down. And we can actually map this out into a modern framework called the capital cycle theory. It's an exact 4-step mechanical process. Step 1, the flood. A shiny new tech shows up, the potential returns look incredible, and capital just pours in. Step 2 is the boom. Money keeps pouring in, competitors pile in way faster than actual demand is growing, and suddenly supply is massively overbuilt. Which leads straight into Step 3, the collapse. All that shiny new supply ends up completely crushing the very returns that attracted it in the first place. Prices fall and people lose a lot of money. And finally, Step 4, the inheritance. Capital flees, the original builders go bankrupt, and some smart, patient buyer walks in and scoops up all those physical assets for literal pennies on the dollar. Now, the absolutely crucial thing to remember here is that investors constantly ignore this history. As the billionaire investor Howard Marks loves to point out, people get totally intoxicated by the possibilities of a new technology. They insist the old rules just don't apply anymore. And that's when they utter what are arguably the 4 most dangerous words in the entire financial world. It's different this time. They honestly believe that because the technology itself is so revolutionary, the basic economic laws of supply and demand are somehow just miraculously suspended. Trust me, do not fall into that trap. Section 3. History always rhymes. Let's look at how these cycles repeat. Mark Twain supposedly said that history doesn't repeat itself, but it often rhymes. And boy, does it ever rhyme when it comes to capital cycles. We can prove this exact same 4-step pattern has happened repeatedly across completely different centuries and technologies. Back in the 1840s, capital flooded into British railways until the routes were massively duplicated and returns completely crashed. Fast forward to the 1990s, the US rewrote its telecom laws, and crazy amounts of money flooded into burying fiber optic cables. Boom, then bust. And even just a decade ago, fracking innovations caused a huge flood of capital into shale oil, which doubled production right up until prices collapsed. Flood, boom, collapse, inheritance. It happens every single time. Now, I know what you might be thinking. Okay, sure, but AI is genuinely world-changing technology. And you know what? You're right, it is. But here's the catch. Financial bubbles aren't built on bad technology. Actually, researchers analyzed 175 years of major technological breakthroughs. We're talking the TV, the automobile, the internet. And they found that 37 out of 51 major innovations triggered a massive speculative financial bubble. Good tech isn't the exception. Historically speaking, good tech is usually exactly what triggers the frenzy in the first place. Let's take a closer look at that 1990s telecom boom, because it's a remarkably direct comparison to what we're seeing today. During that frenzy, carriers buried more than $500 billion worth of fiber optic cable. They just kept laying it down. But when reality finally caught up to the hype, a staggering 85% of all that fiber sat in the ground completely unused. So what happened? Bandwidth prices fell 90%, and the Nasdaq plummeted 70%. Those original builders were utterly destroyed by the very oversupply they themselves created. Moving to Section 4, the circular financing illusion. Let's see how demand gets manufactured. Okay, so let's bring this really powerful historical lens right back to the modern AI market. We need to see exactly how the demand side is currently masking the reality of this massive supply glut. But first, let's understand the stakes here. A Harvard economist recently published a study finding that while this whole AI buildout only represents about 4% of GDP, it's somehow accounted for a mind-bending 92% of all the growth in the U.S. economy. Think about that for a second. Without the AI build-out, the U.S. economy barely grew at all. Our entire economic system right now is basically clinging to this one single massive bet.
So, with stakes literally that high, how are these companies possibly justifying spending all this cash? Well, it's a little trick called vendor financing. Back in the 90s, telecom companies faked demand by spinning stories about internet traffic doubling every 100 days. Today, they're faking it with money. Basically, equipment makers lend their own customers the money to buy their gear. It's a neat trick because it manufactures the appearance of real end-user demand. It gets booked as revenue, it validates all those aggressive growth narratives, and everything looks amazing, right up until they simply can't extend credit anymore.
Let's actually follow the paper trail on this to see how it plays out in the AI space today, because it literally loops right back on itself. It goes like this. Nvidia funds OpenAI. Cool. OpenAI then takes that exact money and pays Oracle for cloud computing services. All right, Oracle then takes that money and goes right back to buy more Nvidia chips. The money is literally just making the rounds. And here is the crazy part. Every single time that money changes hands, it gets counted on the books as brand new demand. A huge chunk of what looks like an organically booming market is really just the exact same money going around in a circle.
Section 5. Cracks in the AI system. Let's see where reality is finally catching up.
Look, circular financing is clever, but it can only defy economic gravity for so long. Let's look straight at the eye of the storm. OpenAI, undeniably the hottest company in the world right now. As heavy-hitting competitors like Google, Anthropic, and Meta flooded the market with their own very similar products, OpenAI's returns predictably started getting compressed. Recently leaked financials revealed that OpenAI lost $38.5 billion in a single year. $38.5 billion. And crucially, their sales and marketing spend jumped by more than 400% just to fight off all this new competition and try to keep people actually using the product. The boom phase of the cycle? Yeah, it's arriving right on schedule and returns are falling. And honestly, we're seeing the fragility of this system absolutely everywhere right now. Just recently, the major chip maker, Broadcom, guided its AI sales down, and we're talking just a few $100 million lighter than expected, barely a blip. The result? Around $300 billion of its total market value just vanished in a single trading session. Poof, gone. When a simple rounding error in guidance instantly erases $250 billion in a single day, that brilliantly illustrates a market that is priced for absolute perfection. Make no mistake, this is not a healthy market. It's an incredibly fragile one. Finally, Section 6, Pioneers, Arrows, and Settlers. Let's talk about who actually wins. So if this cycle is basically destined to turn, who actually comes out on top when the dust finally settles? There's a great old business adage for this. The pioneers get the arrows and the settlers get the land. Think about it. The first companies charging into a brand new market take all the hits, they shoulder all the risk, and they absorb the massive early losses. Think of search engine pioneers like Alta Vista, or early rideshare companies like Sidecar who fought all those brutal early legal battles. They took the arrows. Then the settlers, companies like Google and Uber, calmly walked in, avoided repeating the early mistakes, quietly copied the model, and totally dominated the land that the pioneers had cleared for them. So, the really crucial takeaway here is that we are watching the final step of the capital cycle theory getting ready to play out. The first movers flood in, they prove the market is real, and they bankrolled this massive, unprecedented oversupply of infrastructure with literally everything they have. But eventually, they are completely destroyed by the very oversupply they created. Then, those smart second movers, the settlers, walk in and inherit those deeply discounted state-of-the-art assets for pennies on the dollar. And that brings us to the ultimate question we need to be asking. This entire fight happening online about whether AI is a bubble or a breakthrough is completely the wrong fight. The quiet, mechanical reality of capital flow is what actually dictates the future here. As you watch this $725 billion AI build-out unfold, the real question you shouldn't be asking is whether the tech is real. It's real. The question is, in this massive capital cycle, who floods in, who drowns, and who inherits? I want you to really think about that the next time you see a breathless headline about the AI boom. Thanks for joining me on this explainer, and remember, keep questioning the noise.